My session 2, that is quantitative methods. But what I want from you is, I will give you two things today. One is the concepts that are really important. What we need to get two things. One is how it applies, how it works, right? What is the concept? And then on micro level, how to solve the questions, which is the ultimate goal to pass your CFA level 1 examinations, right? Questions are pretty straight and simple. Whenever we start quantitative methods questions, as a good student, our approach is to reset our calculator to restore to the factory setting if we have used it too much before for some calculations. Let me give you a concept of timeline, which is just for your understanding. I will build up some scenarios. Suppose today we will invest 1,000 every year for next 5 years. I will get 200, 200, 200 and 200. So same thing, if I make it in a line, that will make more sense to me to understand, right? If you see minus sign with any kind of cash flow means this is outflow. So we can see today, zero is today. We invest $1,000. Every year we are getting $300. So if you add these 1, 2, 3, 900, 12 and 1,500. So you invest 1,000 and you get 1,500 over the period of time. So your net return is $500. This is the concept of timeline. When we will solve the questions, it's better to make a timeline. He will say, today invest $1,000. So 0 minus $1,000, and he will say the first return will come after 4 years. So means year 1, year 2, year 3 will be 0. Yes, this is the concept of timeline, right? This is the concept of the timeline that you have to make it for your problem solving sessions. As a concept, it's very clear that you have to make a line and you have to allocate today, year 1, year 2, year 3. This will help us. He says a cash flow that occur in present is put at time 0 and it's always with negative because it is going out. When the money is coming in, it is good. It should be plus, right? Cash outflow payments are given a negative sign and cash inflow are given a positive sign. This is, while using a calculator, we'll see that if you don't put minus sign, so your answer will variate, it's a little bit, so we have to be very careful about it. Let's see what is the interest rate. Interest, in general, we know that if you give money as a loan or if you take money as a loan, the extra money is called interest. So I was explaining you interest rate means when you give extra, and rate is really important because if people pay more money as interest, then they have less money to invest and more pressure on them in terms of business repayments. That's why interest rate is a very important thing. And we as analysts, if we will work for those projects for 20 years, 30 years, when you buy a plant life is 30 years. So we have to think about cash flow of 30 years. So in 30 years, we cannot control tomorrow, right? So how we will control 30 years in planning side, I'm telling you, right? In planning. So you have to be very careful with these concepts. These concepts will save us from unseen outcomes. If we are discounting, if we are thinking today that after 30 years whatever we'll get, it will be equal to this value as of today. So in fact we are helping decision makers to take effective decisions through our knowledge of time value of money. So he says required rate of return is a rate which an investor is looking for. Means you are an investor, you went to a bank says 3%, right? 2.5% is prevalent rate. If I give my money to any bank, they will give me a fixed 1 year 2.5%, that is pretty low. I may go to a stock exchange broker, he can give me 9%. If I'm too aggressive, I can start my own business and I can see maybe 20%, 50%. Some business has bigger margins, right? So this is the rate of return that is in your mind as investor. That is your required rate of return. So whenever we will, and as an investment banker, we have different investors, right? They have bundle of cash and they are looking to us because we are regulated bank, we are regulated by central bank, for example. So they want to give you money. So you as a banker knows that this investor is good with 3%. So for this project, let's approach this investor, right? This investor will take a risk, but he is looking for a high interest rate. So let's approach this way. This is how investment bankings move. In that way, so we should know the required rate of return for a particular investment that investor and savers require to get them to willing to their funds. Means if you tell them, okay, what is your required rate of return? You will say 7%. He will say yes. Okay, I will invest in this project. Required rate of return sometimes we called as discount rates as well. So whenever we do discounting, this is moving around the same concept of required rate of return. We can also view interest rate as the opportunity cost of current consumption. This is opportunity cost in economics we'll study. That is the cost of next best alternative. Means if you have a land, you will make a school, you will get 5% operating profit. If you make a hospital, for example, you will get 7%. So this 7 minus 5 is either your opportunity gain or opportunity loss, right? So this is what he says, that this interest, because you will block your money for a certain period of time in a certain investment, might be if you utilize this investment into a smarter option, you might can get more money out of that, right? This is what is the concept of opportunity cost. He gives some example, like suppose the market rate of interest on 1 year security is 5% when the current consumption is chosen rather than saving. The opportunity cost is 5% interest foregone. For example, you were doing a job, you resign your job, and now 6 months you will study CFA level 1. 6 months you might can take your salary, multiply by 6. This is your money that you are foregoing to get CFA level 1. So your job has become the opportunity cost of CFA level 1 if you have left your job, right? If you are doing your job, then of course we have to see what is the other opportunity cost. Okay, what is the breakup of interest rates? Mean if you see interest rate, what is the interest rate? Generally in banking we have LIBOR plus bank rate. These are the terms that we will use in book 4 and 5. So he says the real, when the word real means inflation adjusted, right? Maybe a gross rate of interest is 8% and inflation is increasing 2%. So your real rate of interest is less, 6. Real interest rate of interest is a theoretical rate on a single period loan that has no expectation of inflation in it. Means inflation is already adjusted, so it will not have any chances. Nominal, which is the gross general, that is real risk plus expected inflation. Means someone is saying invest in this project, 8% will be the return, but on the other hand inflation will also increase in next 5 years, so we will add the expected inflation to get the nominal rate of investment. Required interest rate on a security is total of nominal risk-free rate, default risk premium, liquidity premium, and maturity risk premium. What are those by name? Liquidity is the ability to get anything into cash, right? When you have cash, we say you have liquidity. If you don't have cash, we say you are not liquid anymore. You have become a solid, right? So this is liquidity premium. Maturity risk means if you are going to invest for 5 years, 5 years your money is in the risk, right? Even it is with bank or regulated ones, but still risk is there. You have to wait 5 years to get your principal money back and what they agree with you, right? Maybe 5 years after, you don't know what is the situation, right? So when you wait for a product to get matured, you get a maturity risk premium, right? There are two words in our financial management. One is premium and one is discount, right? If anything costs you $1, you sell in $1.5 to the interested people. This 0.5 is a premium. If you have a worth bond $1, people are not willing, maybe because of some press issue or some reputation issue, you have to sell 0.5, right? So below the cost, that will be sold as discount, right? These two words are really important for our day-to-day life. Effective annual rate is really interesting. There's a formula that 1 plus periodic rate into m minus 1. What is periodic rate? Stated annual rate. M number of compounding period per year. Let me give some highlights about compounding. Okay, see, go in typical, Jewish interest calculations. That is the compounding, the origination of compound interest. What is that? How it works? If you have given $1,000 to me, right, and you agree with me every third month, it will be 3% quarter interest I will pay, right? And after one quarter, say $1,000, 3%. So maybe 300 or 30, right? 30, I think. 30. So the new amount after 3 months for the new 3% calculation is 1,000 plus 3% of 1,000. So means you are not applying interest only on principal, you are applying after compounding with interest rate, right? That is called interest over interest, right? So we have to see the concept of compounding. Compounding is the way we will charge the interest. It will be monthly, it can be quarterly, it can be bi-yearly, or it can be yearly, right? These are 4 options that we can have. So he says bank will quote a saving rate as 8% compounding quarterly, or bank can tell you, see, the rate is 3%. Now it is your call to understand this is quarterly, monthly, bi-yearly or yearly, right? But at the end of the day, we should understand what is the effective rate of interest we are paying, right? Maybe you are assuming, credit card guys generally, they tell the monthly rate if you want to have 2.5%, 3%. Personal loan guy will come, he will tell you 1 year loan amount, right? So everyone has its own mindset, every product moves in its own way. Bonds sold another way, securities sold another way, and loans sold other way, investment products sold another way. So we should harmonize and calculate the effective rate of interest. So just for your example, he said 8% quarterly. Quarterly means 4. So immediately I will divide 8% divided by 4. So that will be my 2% per quarter. It says the rate of interest that investor actually realizes as the result of compounding is known as the effective annual rate. Effective word that when we put effectively what we are paying. This is an important concept. Effective, gross means general. Effective means that we are actually, it is hitting us as the actual. So formula is very simple, 1 plus periodic rate. Now we will do some examples related to it. It says compute effective annual rate EAR if the stated annual rate is 12% compounded quarterly, immediately divided with 4. Quarterly means 4. So you will see 3%. Then you have to use the formula that is 1 plus your period, and this is, you remember, periodic rate. This is the formula, 1 plus periodic rate into the power is m. Same way, he give you information 12% compounded quarterly, immediately we divide with 4, we get the period, and this is we will put here because this is 3%. If you divide with 100, that will be 0.03, right? So 1.03, and quarterly because we have to do, so here we will take the quarter because m is quarter, right? He give information in this way that our annual rate is 12 and m is 4, so 12 divided by your m, you get the 3 will be here, and then minus 1, so you will get the 12.5% is the effective rate that you have to pay. So in your calculator, after dividing, when you get 1.03, because it's a power, there is a button called YX, right? And you will press 4 and you will do the equal sign, so you will get the 12.5%. So they told you 12, effectively it was 0.5% more. This is the advantage to calculate the effective rate of return. So this is 4 divided by 12. So any question we can solve now, right? I will change these words only. It is written like quarterly, I will say monthly or daily, we can do this way. Let's move. So this table. A couple of more calculations which is easier than what we discussed so far. Okay, moving forward, we are going to discuss that how in exams you will solve time value question. First of all, you will use your calculator, otherwise it will not be possible. If you see your calculator, it has n, this is interest rate, present value, future value, annuity payments, and compute. I will discuss one question. It says future value of a single sum. Calculate future value of $300 investment at the end of 10 years. So the first thing as a student for us is to find out what is 10. It is n, it is iy, it is what, right? So generally number of years is your n is 10. If it earns an annually compound rate of interest, rate of return 8%, so ideally you have n, you have I, interest, right? And he is asking you to calculate the future value. Present value is already with you, right? So let's take your calculators. First you will enter 10. Don't enter n first, because first the value, then the button, right? So 10, press n, then 8, press interest, then minus 300 PV, present value, then the button CPT, that is the top most on the left side, and press the button fair value. See if it is giving you the same. If no, then there will be a entering issue, because minus 300 is required. This is n is equal to 10, I 8, and we get the future value. Okay, present value of a single sum.